Hello, welcome back to Corporate Finance class. And today we'll be talking about capital budgeting and investment decision, capital budgeting and investment decision. And we will look into um, the key concepts of capital budgeting in terms of net present value, NPV, and then IRR, which is internal rate of return, and we will look into payback and profitability index. And the this is actually divided into two, as we will see. We'll also look into the risk management in capital budgeting, and we'll look into real world application in multinational setting. What is capital budgeting? Capital budgeting is the process by which firm determines how to allocate their capital among different projects or assets. And typically, it involves long-term investment in fixed asset, new venture, or expansion opportunities. It is also the analysis of potential investment projects to assess whether they are worth undertaking given their expected cash flow and the firm's cost of capital. And it is a core process for how firm evaluate and select long-term investment. It also involves large long-term commitment of financial resources that shapes a company's strategic direction. Also, capital budgeting helps businesses identify, evaluate, and prioritize investment projects to minimize long-term profitability and shareholders' wealth. And lastly, it's not just about numbers, it's about making decisions under uncertainty that will drive future growth. What are the types of capital budgeting? We actually have two types or categories of capital budgeting methods. And this is the traditional, which is also the non-discounting method. And we also have the discounted cash flow, which is, um, I mean, the discounted cash flow method. And these two will be what we'll be discussing on and we'll elaborate upon in this module. And for the traditional method, this is actually simple and fast, but do not consider the time value of money. And example of this include the payback period, the accounting rate of return. We also have the discounted, which talks about that we do not account for. I mean, method do account for the time value of money as against the traditional one. It do account for the value of money, time value of money, and recognizes that money today is worth more than money tomorrow. It's saying that the amount that you have presently is worth more than what it is tomorrow. And it involves discounting future cash flow back to their present value. An example of this is the NPV, IRR, the profitability index. Taking it one after the other. When we talk about payback period, what is payback period? It's actually the time it takes for a project accumulating cash income and inflow to recover the initial investment cost. So it talks about the actual time in terms of year, in terms of the beyond year, in terms of months or whatsoever period it is for an investment to be able to recover the real initial investment cost that was incurred into it. And it's a key tool for assessing how quickly an investment will become self-sustaining in terms of liquidity. And while it ignores profitability beyond the payback horizon, it is a practical tool for firms concerned with risk and liquidity. And bringing it the calculation to calculate the payback period, it's actually the initial investment divided by the annual cash flow, and this is for the equal cash flow. When we have equal cash inflow, then we will say it is initial investment divided by the annual cash inflow. For example, if there is an investment of 120 million naira in a new machine, it's expected um, to bring in 40 million naira annually. How much time will it take for the money to be recovered? And that's why we say the initial investment, which is 120 million, divided by 40 million, makes it 3 years. It will be 3 years for such to be recovered. So the company will recover its initial investment in the next 3 years. And looking at the uneven cash flow, where there is no when the cash inflow is not actually the same over the years. Now, for that, the calculation is the year before full recovery plus bracket open unrecovered investment at the start of the year divided by cash inflow of that year. And you can see from the example, um, there is an investment of 150 million, and the cash flow for the first year will bring in 40 million, the second year 50, the third year 30 million, and the fourth year 60 million. And you could see the accumulation, how it continues. So you see that 150 was invested, and at the third year it's already 120, and it remains about 30 million for such to be recovered. In order to get that, then it will be the year before full recovery, which is the third year, which the 120 has been recovered, plus 30 million naira that remains to meet up with the 150, and divided by 60 million for that year, year four, and that gives us 3.5 years. It gives us 3.5 years. It gives us 3.5 years to be able to recover such. What are the merits of payback period? It is very easy to calculate and understand. Also, it prioritizes projects that generate cash quickly, which reduces liquidity risk. It is particularly useful in uncertain environments like in Nigeria, where long-term forecast can be unreliable. And lastly, it is a valuable tool for small and medium-sized enterprise with limited access to capital. And it has its limitation also. And the limitation is it does not consider the time value of money, treating cash flow equally regardless of when they occur. It's completely um, disregard any cash inflow that occur after the investment have been recovered, and there is no profitability measure put in place. And the last one is that the cutoff period used to accept or reject project is often set arbitrarily by management. And talking about the um, accounting rate of return, it's actually the ARR is a profitability measure that uses accounting profit instead of flow to evaluate an investment. It is a non-discounting method that does not account for the time value of money, and the formula is average annual accounting profit divided by the initial investment or average investment multiplied by 100, and that is the ARR. This is not the all that we have. You know, I said we also have the this DCF method, and you can get that perfectly well in your notes. You can go through the notes for as those that enrolled. So in conclusion, capital budgeting is crucial for making long-term strategic investment decision. Traditional method like the payback period and ARR are simple and useful for initial screening and liquidity assessment. However, due to their limitations, they should be used in conjunction with more sophisticated methods like NPV and IRR to ensure all factors risk, liquidity, and profitability are considered. Thank you.